Good afternoon, everyone, and welcome to our live webcast with myself, Mitchell Snedden, and we've got Gaurav, Sodhi and James Carlisle. And today we're going to be talking about the Intelligent Investor Equity Income Portfolio and answering all the questions that you guys have at home. So speaking of those, just below the box with the video there that you can see is a little question box. So if you have any questions that you want to send in and ask James and Gaurav, well, type them in there, hit submit, and we'll try and get through as many of those as we possibly can. But guys, let's just get started by giving a bit of an overview on the Intelligent Investor Equity Income Portfolio. This is run as a separately managed account, so people can invest in it. But let's start out with, what's the actual purpose of the portfolio? What's your aim with the portfolio?
Well, the idea with both our portfolios, the starting point is value. So we put together a portfolio of stocks which we consider to be undervalued, as undervalued as we can find within the parameters of a sensible diversification between stocks and sectors. And that's the size of it, really. But obviously, then there's a clue in the name, which is that we try to find a bit of extra yield within those parameters. So, we won't buy a stock just because it's got lots of yield, if we don't think it's undervalued. If we think a stock is sufficiently undervalued and it has an attractive yield, but little growth, then that's a reason why it might fetch up in the income portfolio as opposed to the growth portfolio.
The other point probably to make, Mitchell, is that we are agnostic about the index as well. So James, we don't go out and see what the bank weightings are and adjust our own weightings depending on what the bank's weightings are. We don't own Telstra because it's a big chunk of the portfolio.
No.
We don't own Rio because it's a big chunk of the portfolio. We genuinely try and find stocks that are mispriced or underpriced, and we put them together in a sensible, risk-tolerant way. And it doesn't get too much more complicated.
I suppose the one thing that you'd add to that is if you're always trying to have your most undervalued stocks, then you could be changing them all the time as you find other opportunities. But I suppose once a stock has got to a price where you think there's a margin of safety, it's cheap enough, you're happy to buy it, put it in the portfolio. Then after that, it sort of gets a bit of a bias. There's a bias towards incumbency, towards the stocks, towards holding, because otherwise you end up trading too much. You end up fiddling about. So once the stock is in there, we need to find another really good opportunity in order to dislodge it. It's not as if we sort of wake up and think, oh, this one's a little bit better, so it's time to make a change. We try to run everything very slow because that, we find, keeps our focus better on the long term. If you're changing things daily, monthly, weekly, you find that naturally draws your focus towards short-term factors, and we try to maintain. We think the main advantage is being long-term.
Well, speaking of being long-term, I believe the average holding period for a stock in the portfolio is approximately 4 years, give or take.
It was that at the end of the first year, and it would be the same now, roughly 3 or 4 years, something like that. Yeah, so that is a portfolio turnover of about 30%. So, and that's pretty good, I think. Yeah, and we'd look to maintain something like that. Whereas I think a lot of people are more, other people are down near a year or so even. But
and another thing that caught my attention when I was very first looking at the portfolios many moons ago, both the Intelligent Investor Equity Income Portfolio and the Growth Portfolio are as close to fully invested as they possibly can be at all times, generally speaking. Is that correct?
Yeah, there's this benefit of incumbency thing. So because we don't like to sort of sell things on a whim, if we don't mind holding a little bit of cash, but we're mindful of the fact that we don't think we can time markets, and B, equities have tended to do better over the long term. We see no reason for that to change. So, if you're sitting there with 10-20% cash, then over the long term that's going to be you're either timing the market or you're going to have a handicap over the long term. That said, if we're finding that there are things that we would like to sell because we just think they've got a little bit big and they're not showing as much value as they did, then we don't have to have a stock to reinvest that money in straight away. We might make the sale, we might hold a few percent. I think at the moment the equity income portfolio holds a couple of percent in cash. And we might make that 5%, something like that.
It's fair to say, James, that we're happy to hold cash, but we don't aim to hold cash.
Yeah, absolutely, yeah. And we don't, if we do hold cash, it's because we've sold something and haven't got another idea. It's not because we sort of think the market's overpriced anything like that. We don't try to make that sort of judgment.
And speaking of that, right now, the market was pushing towards the 6,000. I know we don't focus on the market. We're index unaware, 100%, as you said before. But for investors sitting at home, they've been monitoring the portfolio. They've been watching it, going, is now a good time to invest in it? Is now not a good time to invest in it? Because when you do invest in a separately managed account, we go out there, we buy all those stocks for you on that day when the cash lands. How would you, if you were someone sitting at home right now, looking at this portfolio and thinking about the market, but also wanting to invest, a lot of people are hesitant to invest right now because of where the market's at. How would you...
People have this idea that because it's gone up a bit, therefore it must be expensive now, which isn't really the case. I mean, the market has gone up throughout history, and it goes up, it goes down. The good time to invest is when you've got the money, when you've decided that you want to commit your money to equities over the long term. That's the time you want to be investing in shares. And if you're hesitant about it, then it can certainly help you sleep better if you stagger it out over 6 months.
So dollar cost averaging.
Yeah. I mean, look, I'm not sure that the arguments on dollar cost averaging over the long term are, they're somewhat confused anyway. But I think it helps you. The thing is that the market doesn't tend to. What am I trying to say? You can win, you can lose, and over 6 months, if you drip your money in over 6 months, the market might fall in 7 months. I mean, the movements over 6 months don't tend to be that great. So the benefits over the long term have generally been from being in the market. And so if you're dripping money, if you're holding money in cash because you want to drip it into the market over the next year or two, then you're fighting against that. So.
The other point I'd make is these are actively managed portfolios, so we don't hold stuff in there that's going to be laden with risk or vastly expensive. So every time you want to invest in the portfolio, there's a very good chance, I'd say, that you're investing in a portfolio of specifically selected stocks that do look attractive, have decent prospects, and meet a whole long list of investable criteria. So I think that's, if you're only looking at an index or a passively invested vehicle, then perhaps you might have some cause to show a preference for timing. But in an actively managed vehicle like this one, we are always trying to hold companies in there that deserve their place in there, and it's a tightly fought contest to get a spot on the buy list and then actually in the fund. It's a long list, there's a very rigorous process we go through, and there's a long list of criteria we act upon to make sure that every holding deserves its position. And
we do get a lot of questions actually on the client-facing side of things, with people saying, well, why am I buying into holds? Stocks that we've got hold calls on. That's exactly why, because they're a hold as well, they're there for a reason.
That's the nature of investing money, full stop. If you've got a lump sum and you want to commit it to the market, there are two ways of doing it. You either be patient and you wait for the buyers to come along, or you put it in the market. That's necessarily going to involve a bunch of holds because, I think our buy list, we've currently got about 10...
Maybe even less than that.
Yeah, I think, well, there's a couple of LICs, so maybe it's... Anyway, and so if you're going to buy 20 stocks, you're going to need to have some holds. And buy, hold, sell, they're labels we put on stocks, but it's a spectrum. And you've got to weigh it all up against wanting to have your money invested. And so the portfolio at any point in time is, it's as I say, with a bias towards incumbency, which isn't necessarily there for the initial investor. They're the stocks that we're comfortable holding at the current point in time. Yeah.
And we've got a record with this portfolio as well. I mean, I don't think you need to have every single stock in your portfolio available as a buy at every single point in time to do well. I mean, we've got a 15-year track record of running this portfolio, firstly as a passive vehicle, now as an actively investable one. And the approach has worked over that time period. So if you had replicated the portfolio 10 years ago, there would have been plenty of holds in there. But the holds are in there because we think they'll do well over time, even though they're adequately priced today. So I think I can understand why you'd ask the question. I think it's a good thought process to go through to make sure that everything deserves its spot. But it's a process that we as managers go through as well. And every company in there has been specifically selected to be in there.
I think. I mean, it's perfectly valid to sit at home and say, right, well, I'm going to wait for the opportunities to arise, and I'm going to build a portfolio over time, and that's hopefully our research can enable people to do that. But if you're deciding that you want to invest into a portfolio, then you're necessarily, whichever portfolio that's going to be, that's going to involve some holdings which, for whichever manager, us in this case, wouldn't necessarily be first on their list for today, because you've got to let stocks have time to play out.
Right. Speaking of stocks, can you give us a couple of examples of stocks that are in the portfolio, the investment case behind them, the thought process that you go through when you're selecting positions specifically for this equity income portfolio?
Well, we've got there's 25 odd stocks.
Do you want to pick one and I can pick one and maybe...
All right, well, Trade Me would be, I suppose, a good example of a stock. So we've had that in the portfolio, I think, since it started taking real money, nearly a couple of years. Look, what we liked about that was the fact that earnings had sort of stalled, earnings growth had stalled a bit, but this was mainly because, I mean, obviously the starting point with this is it's a fantastic business with huge market shares in New Zealand, classified ads space in New Zealand, for those that don't know. And its earnings growth had stalled because it was investing hard. There were various things it needed to do. It needed to produce some mobile websites, it needed to produce apps for iOS, for Android, all those things. So all of that requires a lot of investment, improve the functionality of its websites, and that was really keeping it. All of that stuff should have been done before. Really, it had a bit of a backlog, so it was playing catch up with the investment. All of that was coming straight through the profit and loss account. So when you build a factory, that goes on the balance sheet. It doesn't actually it doesn't actually operate as a loss this year. Whereas when you're sort of investing in IT staff to build some fantastic software, typically it'll go straight through the profit and loss account. So while that was slowing down the earnings growth, and the market was sort of looking at this stock and thinking, well, we don't want to really price it for much growth because they weren't seeing much growth. The truth is, it was actually building. I mean, all this investment builds barriers to entry and actually enhances the value of the business over the long term. And so when it's able to take its foot slightly off that pedal, the growth returns, which is what we've seen now. So it proved to be a very attractive time to buy the stock. And so, I mean, I suppose the cash generation of the company and what it was choosing to do with that cash, I suppose, is what drew us to it.
It's Trade Me is one of my favorite investment theses we have at the moment. It's actually our biggest holding in the income portfolio right now. And what I really liked about it was that it plays on the idea that the reported profit and loss, or accounting in general, is a curated view of reality. It's an accountant's fiction, and there are lots of strict rules that go into what you can say and can't say. It can deviate from reality. And if you can get to what the underlying picture of the business is, and what is and isn't being reflected through the accounts, you can come to an independent valuation of the business that can be different to the market's valuation. And that was exactly...
The market's very focused on earnings, really.
That's right.
Over the next 2 or 3 years. So if you can find an argument for where the earnings, are different from the reality of cash flow and long-term profit growth, then you could be onto something. And that was, I think, the case with Trade Me. Seek would be another one very similar there.
The other one I was going to bring up, actually, James, was South 32, which is maybe atypical of the kind of investment that
a lot of people don't usually associate those types of the South 32, BHP, etc., with as income stocks.
Yeah. You do get to a point when the prices are good enough and the capital allocation of the business is supportive of a dividend theme. And we got there with South 32 because it was a spin-off from BHP, which spun away all the assets that weren't considered good enough to be in the BHP portfolio. So it got this moniker very early on of crapco. Everyone thought it was the lousiest parts of BHP, and so it was being valued extremely cheaply. And we were able to pick it up at a really attractive price. And what the good thing about it was spun away with very little debt, but lots and lots of cash generation.
But they were also very good assets, weren't they? So they were
actually very good quality
It's
assets.
not that they were the bad assets.
Yeah.
It was just the sort of small fiddly assets that BHP didn't want to. So it's not. That's I think where the market got a misconception, because they're actually very strong assets.
So the assets only represented 3% of BHP's profits. But it still independently was, a multi-billion-dollar business, and it was being completely mispriced. And management were very focused on much better capital allocation. Once you have assets that have been neglected by the parent, a new management team can come in there and take costs out and deliver cash back to shareholders and not have to subsidise other parts of another empire. So there was a very attractive pricing opportunity, but there was an also opportunity to take free cash that used to go into BHP and then send it back to shareholders. So it fit the criteria fairly well for the income portfolio, even though it's not the most obvious idea when you mention it. And I think that's a feature of the portfolio in general. We're not very dogmatic about what gets into it. We're not just going to put in the highest yielding stocks in the market.
You're
That's
not
a
just
silly game
labelling
to
this
play.
is not a traditional income stock,
Correct.
so we're not going to have a look at it.
No,
That's where it comes back
that's
to
right.
value.
We start with value, and then we try to eke out a yield from that. But if you're investing in a yielding portfolio, which is not undervalued, you're going to find the danger is over time that yield, the dividends get cut.
And in fact, South32 is now returning cash back to shareholders. It's got a huge cash position, and it's fairly attractively placed. We will take. It's not the kind of stock we'd hold forever, James. I'm guessing we will take. Profits at some
I think
stage.
it depends. Yeah, it depends on the price. I mean, at the point, but before we think it gets
That's right.
overvalued, we'll be
But it has contributed quite a bit to returns, and it's a good example of where we always say that to do better than the crowd, you need to do something different to the crowd, and this was an example of us doing exactly that.
Excellent. Now, let's get to some of the questions. We had a fair few come through. So, members sitting at home watching this, if you haven't submitted a question yet, please do so. There's a little box just below the actual video. Put in your name and send through the questions, and we'll get to them. So, guys, the very first one is from John, and John asks, are there any listed property trusts that pay a good yield at the moment? He did put in there a good unfranked yield at the moment.
Well, they're all unfranked, the listed property trust, because they pass through the profits before the tax. So, look, there's none on our buy list. I suppose is the first answer to that. They've done extremely well the last couple of years, but we responding to that quest for yield that people have had, and we're not really. Yeah, there's none on our target list at the moment. We do hold Ale Property Group in the income portfolio, which is an interesting one because you see that actually that has rent reviews coming, and so it has inflation-linked leases, but it has some rent reviews coming next year, which is capped at 10%, a 10% rental increase, and then in 2028, 10 years time, which is uncapped. So you get the full market rent review all the time. Its main customer, which is ALH, Australian Leisure and Hospitality, 75% owned by Woolworths, is investing in these properties. In some cases, building Dan Murphy's stores and that sort of thing. Now that's going to increase. So in 2028, we think there's scope for a huge uplift in rent. Now 10 years away. That's it's actually, I think the price is showing that it's beginning to be interesting to be. When we first started buying the stock 3 or 4 years ago, I don't think it was far too far over the horizon. Whereas now it's beginning to get onto people's. But we still think it's attractive based on that potential, which I think is not yet fully recognised.
I think it's unusual to do very well out of a property trust simply by buying something that yields an attractive yield. There's not really an opportunity for mispricing there. these businesses aren't property trusts aren't terrific. The yield looks great because they can't retain profit and have to pass everything through. But every time they want to do anything, they have to come back to shareholders and raise money. So the high yield is a function of the structure, not necessarily the function of the profitability of the business. Ale was different. When we bought Ale, it was extremely cheap, and it has what's called a triple net leasing arrangement. So its tenant actually pays for all the upgrades, but Ale gets to keep all the benefit of the capital appreciation of those upgrades. And it has a incredibly attractive rental increase structure as well. It's actually, James, unusually for a property trust, it's more than doubled since we first bought it for the portfolio.
Yeah, pretty close, but pretty much doubled, and it's been delivering a good yield.
And delivers terrific yields, yeah. So it's probably a better example of the type of business we would go to rather than a traditional REIT.
I suppose the way we look at property trusts is, in our research, we try to set out what we expect for growth, what we think are the risks, and then we explain what that means for, on a total return basis, given the current yield. And I think really that it then depends on the individual whether that yield is sufficient. Really, it depends on. You could argue, people who have no dependents, 90-year-old, needing some income. Well, why wouldn't you? Whereas people who are still looking for value and not, then maybe the return's not enough for you. So there are none that are really cheap enough at this point for us to be looking at very closely. Yeah.
Well, John, it might be the same John, it might be a different John, but John's got a question. Do you take into account tax when selecting stocks for the portfolio?
That's a good question. I think you've got to. I mean, ultimately, the value of a stock is the cash that it delivers over the long term, discounted to today's value. That's what defines value. Now, we don't do DCFs, discounted cash flow calculations, very often because they cause all sorts of confusions and messes. But ultimately, that's what you're trying to get to with whatever valuation technique you're using. And the cash that is delivered to shareholders by a company is necessarily taxed. So the answer to that is yes. So how do we do that? Well, we try to normalise the tax rate. So if one year we see earnings that are, have only been taxed at 20%, then we'll be wondering why, and we may well increase the tax rate in our model, or at least in the back of our heads to account for that. In terms of the franking, we don't tend to get too involved in terms of the franking, what that means for shareholders, because that's an individual decision, really.
I think it's difficult when we're running an SMA structure. I mean, everyone's going to have their own sort of different tax regimes, and what makes good tax sense for one person might not make the best tax sense for another. So within the constraints of what we have, we try and be as tax efficient as we can, but those constraints are quite large, and
I suppose
we can't take individuals sort of.
So we're not taking individuals' tax situations into account, obviously, because we can't. But what one's trying to do is to take account of the overall market's tax position, as it were, in terms of how a stock ought to be valued, and that'll tell us, I guess, what individuals would have to make that judgment for themselves, really, I think.
Excellent. Well, we'll move on. There's a lot of Johns out there. Another John.
John's very busy.
Very engaged. John asks here, I'll just get back down to the question. What percentage of an income portfolio should the banks represent?
Wow.
So for us, it's a very small amount. But James, that's because we are largely index unaware. If you were just going to replicate the index, you'd have about 35% of your portfolio.
Well, the bank's about 25.
I think they're a bit more than that now.
No,
somewhere around that. Well, anyway, between 25
and
we
won't argue. But it's that sort of order.
It's far too high, whatever the number is.
That's a quirk of the Australian market. Overseas, I mean, in the UK and America, you won't find the banks making such a high proportion of their stock market.
To hold a third of your portfolio in banks, which are all exposed to the same risks, they're 4 companies, but all exposed to the same risks, is imprudent.
You've got to remember they are risky stocks.
Yeah.
You know, they do go bust from time to time. We saw that only 10 years ago, even slightly less. You know, they do go bust from time to time, banks. We're not predicting anything, but you know, they have bad times, and that's a large proportion.
Yeah.
So we in the income portfolio we recommend that you should have 20% maximum across the sector in a portfolio, and 10% for more conservative investors. And each of the banks within that we have limits of 10%. And the income portfolio holds about 11% at the moment. So it's nearer that sort of conservative end, but that's not for any reasons of conservatism. That's just because, you know, we found a bit of value in them sort of 6 months ago, middle of last year. A bit more than 6 months ago now, I suppose. And so we topped them up, Westpac and CBA, and then they've done well since then. So they've got up to that sort of level, and you know, we're fine with that. But it's a long way short of what the market is, and that's because to have the market weightings in banks is pretty aggressive.
And it's not really the way we think about it. You know, there's not a sector out there where we think, oh, we must have exposure to this or we must have exposure to that. We're quite agnostic about sectors and indexes. We really just want to hold a collection of dividend-paying, undervalued securities, and they can be across whatever sector, and we don't have to concentrate in any.
So long as we have a broad spread of sectors that aren't too closely linked in terms of having similar risks, then that's enough. You don't have to have every single sector.
We'll move on away from the Johns. We'll go to Philip.
Just one more thing to say on the banks is that they are kind of a geared play on the economy. So really, whether they actually add very much to your diversification, because they really track generally what happens everywhere else in some senses. So whether they really give you a lot of diversification anyway is a moot point.
Excellent. We'll move on to a question from Philip. Philip says, if I'm looking to no longer actively manage my ASX exposure, is this a one-stop show in terms of a fix, or should I blend with other fund managers / maybe other models? This is like asking a hairdresser if you need a haircut.
Well, you know, if you have 5 fund managers, especially if they're different ones, then what you have is an index tracker. And if you're going to have an index tracker, you may as well have a cheap index tracker instead of paying 5 fund managers their fund management fees. So, I mean, I would tend to say that it would be a one-stop shop. You know, there's no real, I mean, that sums it up really. If you have too many active fund managers, you're going to end up with the index.
Or perhaps you might be referring to as well, should he split it across other managed products in different, say, asset classes?
Different asset classes. Well, there's certainly an argument for overseas. Sorry, so I'm talking about for Australian equities. I mean, for
but he
did
mention his ASX exposure, but in a portfolio-wide sense.
So for different asset classes, obviously you need to look at different different ways of accessing those. Yeah.
I mean, the fund is it's diversified, so we will carry a diversified portfolio. So there's not too much concentration. Our largest holding is about 6% of the entire portfolio, so it is not a huge concentration in any one stock. We're diversified across industries and sectors, and we tend to focus on sort of the top 200. So we're not collecting small businesses for this particular fund. We do have another fund for that, Mitchell. But for those reasons, I tend to echo what James is saying. I think this is a one-stop solution. If I can just add one sentence in about the alternative. The alternative is to go to an index fund for the ASX, which I think is a really bad idea, because the ASX, unlike most indexes, is, let's take James's number, 25% banks.
Well, it comes back to the banks.
15% resources, and you add Telstra in there, you're up to sort of 40-50% in just a handful of stocks with correlated risks. It's a very bad passive investment vehicle. Passive investing is fantastic. We're fans of it. It works in a lot of cases. It doesn't work particularly well with ASX.
There'd be a reasonable argument for using a passive investment vehicle, and then having some in an active strategy that doesn't have the banks, as it were, which is, but that's probably more like our growth portfolio. But I mean, if you want to be passive is great, but you probably want to find a way of reducing that exposure to those big sectors.
I've been having a look recently at a couple of exchange-traded funds that are equal weight. So they get, say, the ASX 200 and then they do equal weighting of them.
Don't get me started.
Don't get you
Yeah,
started.
well, the problem with that is that it's not the market portfolio, so they're not passive funds. They call themselves passive, but if you're not market weighted portfolios will match the market forever. That's what they do. You don't have to buy or sell anything, subject to things coming in and out of the index. I won't go into that, but they just will, because if CBA goes up 5%, its holding in your fund will go up 5%. If you have differently weighted so-called passive funds, then they'll quickly get out of sync with. They don't replicate the market's movements, so they're an active strategy. They could be cheap and they could be sensible, but it's not passive. You've got to decide whether it makes sense to do that. That's a sort of artificial diversification. You could replicate that at home. You could sit at home with an E-Trade account and buy 20 stocks equal weight, and so why pay any fees at all if that's the case? Yeah.
Now, we'll push on with some questions because we'll look to wrap it up after a few more. But I've got one from Greg here who says, I'm still in growth phase, but like the look of the portfolio. Would it still work for me, and can the dividends be reinvested?
Can the dividends be invested?
I'm not
sure about that.
You
probably know more about that.
Yes, they can be. Basically, when dividends are paid by any of the company, they go into the cash component of the account and then rebalanced. Or when you guys go out and purchase more stocks, it is used for that. It will be rebalanced if, say, a lot of dividends are paid.
That's if you don't take the cash out of the account.
Correct,
because people can draw the income if they
wish. If you are living off the income from this particular portfolio, every month you can have an income sweep that takes place. So basically, when every month whatever dividends and interest received by the portfolio will be swept out to an account of your choosing. So you can do that, or you can do ad hoc payments to yourself as and when you like. But if you are if you're still in growth phase and like the look of this, because if you look at the numbers, it's still definitely there's a lot of growth.
I think this comes back to the point that it's selected first and foremost for value. So we're buying stocks here that are undervalued as best as we can find them. This tends to get the ones with slightly higher yields. If there's something without a yield and we find it undervalued, it's going to go in the growth portfolio, not this one. The interesting thing is that over the long term, since we've set it up as a model in 2001, the income portfolio has actually done better than the growth portfolio in terms of total return. It's sort of 13% instead of about 10%.
That's right.
And that's actually also been replicated since they've been going as investable vehicles. So you have to ask the question whether that discipline of finding stocks with yields actually helps us, and whether actually looking at stocks without so much of a yield actually has penalised the performance of the growth portfolio. I actually think it's probably just the way luck has played out. I think that one portfolio has got to be ahead, and it happens that it's the income portfolio of R2. Plus there's a couple of stocks that going way back that have probably had a disproportionate impact on the growth portfolio. But anyway, never mind that. The point is that I would say the income portfolio is a perfectly sensible way of doing it, and reinvesting the dividends,
Because it's not just a collection of high-yielding companies. It's not just REITs or infrastructure vehicles we're selecting. These are probably undervalued stocks, and that's the reason why the returns have been higher than you'd expect from an income vehicle. And that's the strategy that we will employ in the future as well. So I think that's perfectly fine.
Yeah, the yield is only 4%, which is, I think it's a smidgen above.
Is that including or excluding franking?
That's excluding franking, and that's a smidgen ahead of the ASX. Ideally, we'd rather it was 5% across the cycle, but at the moment that's quite difficult to achieve. And the point is, we're not going to sweat about achieving it. A yield's only good to you if it can maintain its purchasing power over time, its value with respect to the rest of the economy and wages growth and all that sort of thing. And so, you don't want to be sweating too much out of it. If you're putting a yield out there of 6-7%, then you're going to reckon, at some stage it's going to struggle to grow with the economy.
Well, I'll ask you guys one more question. Then I just saw another one pop in, which is right up my alley, so I'll take that. But this one's from Don, and I think it's a good one to wrap on, just to really clarify the differences between the growth portfolio and the income portfolio. Says you have an equity and equity income portfolio and a growth portfolio. What's the main difference between the two? I understand the goals, but I'm referring to the makeup of the actual investments.
So, the income portfolio, I'm just looking at the list now. I mean, so there's stocks like Ale in the income portfolio, and the two banks, of course, and Woolworths is in the. So those are quite. I mean, the two banks, Westpac and CBA, that is, and Woolworths are quite big holdings. CBA is 6%, Woolworths 5%, Westpac 4%. So that's quite a big chunky difference there. And then the growth portfolio, I haven't got it up on the screen, but from memory, so the growth portfolio has Nanosonics in it and Hansen.
That's right.
So Nanosonics is an interesting company making sterilization. Actually, it's not sterilization, it's the other thing they call it, because it doesn't sterilize it, but it does the other thing. It cleans it very well in America, anyway, for probes and stuff. That's Nanosonics, and Hansen makes billing software. There's also TPG in the growth portfolio. So again, these are stocks which
and iCar Asia.
And iCar Asia, yeah.
That's not in both, is it? No, it's definitely just in the growth.
No, it's definitely just in the growth. It's barely in that. It's gone down so much, but so that's less than 1% weighting now. So those are. I'm trying to think of others, but so you can see right there the Nanosonics. Actually Hansen's got a decent enough yield, but I think Hansen might have been in the income portfolio. I'm trying to remember, and we might have sold it at some point.
Yeah.
But
there are plenty of businesses that have terrific prospects that are undervalued and that are growing, but need to reinvest their earnings back into the business to achieve that growth. Those are the sort of companies that probably aren't what people who are investing in the income portfolio want, and so those are perfect candidates for the growth portfolio. The philosophy is remarkably similar between the two portfolios. We're still trying to get a collection of undervalued securities. With the income portfolio, we do need some of the cash to come through as a dividend. If that doesn't happen, we can't really, or there's no prospects of it happening. I think there are, we have had businesses in the income portfolio that don't pay a dividend yet, but had prospects of paying dividends in the future, and that's okay.
Yeah, well, News is in there in the income portfolio. So if they've got the cash flow to support a dividend, but they actually don't pay it, then we don't want stocks in there that are really no prospect of paying a dividend for some time. But I mean, look, we want to make sure that income keeps pace, at least with the economy, hopefully a little bit ahead in terms of growing. So within that, it's we think it's perfectly valid to have a couple of stocks there with decent dividend growth prospects, even if they haven't even started paying a dividend.
So the strategies are actually quite similar. What you will find is that with the income portfolio, a lot of the total return will come in the form of dividends, and clearly you won't have that in the growth portfolio. A lot of the total return will come from capital gain.
Well, the yield of the growth portfolio is about 3.3.
At the moment, it is quite.
So I mean,
that's not by design.
It's not. I mean, it's just how it lands. I have to say, disinfection is what Nanosonics is. As opposed to sterilisation, there is a difference. There we are.
All right, we'll just finish off with a question from Neville. If I invest in the fund, do you provide units or invest directly in the individual stocks?
Yeah, that's right up your alley.
Exactly. Yeah. And Neville also adds on there, great webinar, guys. So
thank you
very much.
Thank you, Neville.
So basically, with the portfolio, if you do go to invest, which you can do online on the InvestSMART website, it's a really straightforward process. You can basically start the investment application and finish it online in about less than 10 minutes if you've got all your documents there. It's a separately managed account that you are investing in. So basically, you are not buying units like a traditional managed fund. We are buying the direct shares for you. So when your cash hits the account, we go out and we buy the portfolio to the weights on that given day. And you actually have the underlying beneficial ownership of the individual holdings. So what that means, if for some reason you wanted to up and leave with the portfolio, you own the stock. You can transfer that out to a broker of your choice or whatever. So that's.
But don't do that.
But don't do it. We're not encouraging that. But that's the level of ownership that you've got. You can take these things away.
And I guess that one of the big benefits would be how dividends are treated in that structure. I mean,
Correct.
I can imagine because you get dividends based on your under your name, and so all the dividend benefits are sort of curated to you. So
Exactly.
I think that'd be a big benefit.
That's a big benefit. There's a couple of other benefits as well with the separately managed account structure. We won't go into them right now, but I'll just also.
That's a different podcast. I think.
Yeah, that's a different webcast. You get to spend 40 minutes with yours truly. Just to let you all know as well, there is no performance fee associated with this portfolio. The management fee is just starts at 0.97% per annum and goes down, so it's pretty attractive.
Well, it goes down if you have a large amount of investment. Not kind of
it
next
doesn't
year
just go down. No. If you add more in, it goes down,
Yeah.
and so it's really competitive out there against its peers in its structure, in its fees, and of course in its performance. So James, Gaurav, thanks for joining us. Members out there, thank you for joining us, and we'll look forward to catching you again next time.